Hi, this is Jim Damschroeder. I'm going to be your guide here. I'm speaking about gsphere.net and specifically about our policy tree. gsphere.net is powerful portfolio optimization, analytics, and asset allocation software and works as an institutional robo-advisor for other sophisticated investment advisors and institutional clients. I'm at the site, gsphere.net, and I'm going to log in. We've put a lot of power behind one little button, and we call that button the policy tree. Just like an investment policy statement governs the manner in which a portfolio gets managed, this investment policy button governs the manner in which some portfolio gets invested. So this investment policy, it's agnostic as to the contents of the portfolio, although we do recommend that there is some adaptation of the policies that are set given the particular type of investments. gsphere.net works with really any type of asset class, or combination of asset classes. And so, unlike security selection, this governs pretty much everything else but security selection of the portfolio. So the idea is that you can feed gsphere.net, security selection or investment ideas, and gsphere.net will then manage that portfolio for you, potentially on an automated basis when integrated with one of our custodian partners in a robo-advisor delivery format. This policy tree could also be used in two major branches, one of which is governing, how to manage that portfolio, how to allocate an investor's capital right now, and how to manage it on a going forward basis, but also what are the results of this strategy from a past. And in that sense of a back test, gsphere offers one of the more sophisticated back testing engines that's available. And it's based on this process that's called a multi-period walk-forward out-of-sample backtest. So the reason it's set up like that is because backtests are notorious, and rightfully so, for containing a lot of biases. But this process called a walk-forward, which means there's a separation between the data that you use to produce the portfolio and then the data in which you use to test it. And then multi-period, so we do that more than once, so the results are not just subject to particular market conditions. And a couple of the big drivers that we set during those back tests are, one, we check it off to walk forward, which means we're going to start at some historical date, as soon as, in this case, our sample period data has ended. So if we set our sample period to end in the year 2000, then the walk forward test is going to walk forward from 2000 up to the present day. And it's also going to re-optimize this portfolio. You just click on an investment policy to highlight it and activate it. So we're going to re-optimize this portfolio. Let's re-optimize it every 10 months. And then we'll rebalance inside each of those re-optimizations half the time, so every 5 months. So we're both rebalancing and re-optimizing the portfolio. And that portfolio optimization is given by this weighting policy. We'll circle back on that when we turn the page, stop talking about the back testing, talk about the ongoing management of the strategy. We could also choose to set a stop loss policy, which does work with our back testing engine, so that whenever a stop gets triggered, that position would be sold out of the portfolio. And you can set that at a position by position level, and a number of different ways to easily, but still algorithmically, set those the stop loss orders. Okay, I'm gonna take off the walk forward, and we're going to look at using the investment policy as if we were optimizing a portfolio right now. Now, investment policies, because they can be pretty complex, we do support the ability to save or retrieve investment policies, and it can also be possible to share an investment policy, which is possibly a way to work with Gravity Capital Partners, where we would set the investment policy and share it to you in your account. I'm going to go ahead and apply here a growth policy, and I'm going to touch on a few things that are happening inside this growth policy. By the way, the policy tree overall does represent one of the major delineators between what's called gsphere.net Portfolio Manager, which is one license, and a gsphere.net Advisor license, which is a license that's a little lighter, a little bit more focused on sales and marketing, analytics, and proposal generation. So here in the investment policy role inside gsphere.net, having access to the policy tree, we set a number of things, and a real important part of this is choosing what the capital market assumptions are. Capital market assumptions govern the creation of your risk, your return, and your correlation forecasts. So gsphere.net, it uses basically those same three underlying ingredients that are used in a Markowitz-based mean variance optimization. However, by our process that separates correlation from being subservient to variance and making its own freestanding dimension of the portfolio management process, it allows the portfolio manager to repackage risk, return, and correlation in any sort of manner that they see fit. For example, easily enough, if we wanted just to simply maximize diversification into a particular strategy, which, by the way, is very effective. In fact, it's actually fairly hard to beat. But in doing so, we can just set this to be an equal vector length. And in doing so, because gsphere.net combines diversification with a utility function, that utility function is a vector length. When all the vector lengths are the same, we're basically saying that we have no preference for one asset over another, except to the extent that it might be a better diversifier. So, we can also do that with something such as like an equally weight policy. An equally weighted portfolio is obviously a convenient way to benchmark the quality of the diversification optimization and the diversification weighted portfolio that you produce from gsphere. Okay. For your risk return and correlation forecasts, those are the product of your sample period or periods. gsphere.net supports a multi-sampling process, which means the portfolio manager has the ability to go in and set any number of different sample periods. Essentially, if you believe that a sample period adds a unique source of predictive efficacy to a strategy, it's probably worth adding to it. In this particular case, we can see we have a 1-year period, 1/1/2014 to 1/1/2015. We also have here a 6-month period, 7/1/2014 to 1/1/2015, and I'm also adding a 9-year period. This is generally one of our best practices, which uses these short-term samples, which capture more of a current environment and momentum effect. It's generally well understood and true that the more recent data tends to be a better predictor than the more distant data. This 9-year period also corresponds to a predictive edge that we've researched that generally relates to 1 or 2 full market cycles, and you start to get into a particular asset's more persistent performance advantages that are not subject just to the current state of a macroeconomic cycle. We also support both relative sample periods. If a sample period is relative, it'll roll forward, with time. So if I were to optimize this portfolio today, let's say I wanted to come back and manually optimize that portfolio in another 3 months. If I have these checked as relative, my dates will not automatically update. If it's not relative, it's going to anchor that sample period to a particular time, which can be very useful if you wanted to, sample from, an event-based period, such as a bear market or a particular event you believe to be of materiality. So what happens is, given the weights of these samples, and here I'm going to give this a weight of 2. So I have one sample period, weight 1, sample period 2, weight 1, sample period 3, weight of 2. Total weight of 4, which means that sample period 3 is going to be exactly 1/2 2 divided by 4, the total baseline risk return and correlation forecasting. Once those risk return and correlation forecasts are created from this, there's other tools in the policy tree to help make sure that those values are pragmatic, to feed into an optimizer. So we've really done some real strides to make sure we're minimizing the potential for garbage in, garbage out. Some easy ones, are setting a floor and a ceiling. So, anything under a 0% return, we are just going to assume has a 0% return, subject then to some, further econometrics. Same thing with the ceiling. Any return that had historically over that period been in excess of 25% will be capped at 25%. A hurdle rate, which could make it, more forgiving, especially if you're sampling from periods that tend to have, produce a lot of negative values, or make it more stringent if, for example, we were in an environment that had, real inflation, or you had otherwise real opportunity costs. You might put that in as a hurdle rate. Shrinkage functions are a powerful aspect of GSPEAR in our investment policy tree. A shrinkage function basically takes the range of risk and or return data, and you can apply it to both risk or return, and the more you go down the scale, none, slight, small, medium, strong, heavy, average, the more you're taking away the differences in the range of those values. The more you're shrinking the range of those values. So interestingly, if we wanted to make a conservative portfolio, if I were to shrink, let's just say we wanted to make a conservative portfolio, but we still believe that there's a quality predictive signal being produced from our return sampling. In that case, I can just take the return shrinkage, ratchet it up, and then therefore that range of returns is going to shrink. And then using a return divided by risk function, such as a Sharpe ratio or Sorrentino ratio or Kalmar ratio, etc. That means that new ratio function is going to have more of its differentiation dominated by the risk value. And therefore, with risk being a more powerful driver of that utility function, the portfolio is going to respond by allocating more to assets that have better risk values, making it more conservative. The same thing is also true if we wanted to ratchet up our risk shrinkage, and we could ratchet down our return shrinkage. Then we're producing a more aggressive portfolio where we're spending more of our data on the return values and less on the risk values. So it's hard to go wrong because it's all backdropped by diversification, but typically the middle third is good unless you really want to make a portfolio more or less conservative. It is also used to map certain portfolios towards particular objectives or specific investor preferences. can also see we support a number of different risk definitions. There's some pretty material benefits to be had from thinking about risk beyond that of just a standard deviation. We typically use, a semi-deviation or an ALTSR. An ALTSR is similar to a maximum drawdown, except it accounts for the duration that one is in that drawdown. But these later two are more sensitive to the sample periods that you've used, and that relevance kind of on a magnitude basis. Semi-deviation, if I didn't know anything about the portfolio and I was advising someone to use, I would tell them to use a semi-deviation, which not only conforms better to what risk really is, right, losing money, but because you're not penalizing an asset because it has a positive price movement, but it also in our studies tends to have a higher autocorrelation, which means a semi-deviation observed in the past is more likely to persist going forward than any of these other risk measures, which means it's more predictive. The more predictive we can make our inputs, the more reliable the results of the optimization will be, and the more better job we could do in meeting and conforming to expectations. Not to mention actually performing for the investors. Similarly to the risk definitions, you can see in these various sample periods, there are three different options for how that correlation gets calculated. A return-based series is based off a time series of returns, and it's kind of the standard in the industry. Not necessarily the best, but it's the standard. A semi-correlation is an invention we had at Gravity where very similar to the semi-variance, where we're taking that historical time series, we're actually just filtering out from that time series any instances for any pairwise set when both assets went up together. The whole point of diversification is to diversify your risks. We don't need to diversify our opportunities. We would love it if we're wrong and our whole portfolio goes up together. We have terrible diversification. But what normally happens is we're wrong, a good bit. And when we're wrong, we want diversification to be there to backstop our portfolio and the capital invested in that strategy. So a semi-correlation better utilizes the correlation data set for the explicit purpose of diversifying against risk. Again, risk being observed loss of capital. Similarly, a price-based series has some use. Typically, I would use a price-based series on my shortest sample period, because that price-based series captures an autocorrelation, which means a correlation amongst assets that doesn't necessarily happen in one single day. So maybe Yahoo reports great earnings today, and Google search engine goes up tomorrow, in anticipation of them having good results. So it doesn't get captured in a regular return-based series, but it does in a price-based series. It's useful for more accurately modeling the future correlations, because we might not know exactly how long we're going to be holding this portfolio for. So it's just another way of introducing diversification, not just into the portfolio at the asset level, but diversification right in here at the level of our assumptions to reduce those risks as well. Okay, I'm going to go ahead and apply this policy tree, and then from this policy tree and this results, any investments that we add to the portfolio. And I'm just going to add here a number of various sectors, and we can see that the risk and return values, we go from the historical values set by that data to then any values that are set after a result of all those policies. In this case, we've normalized those risk values, and on the return values, there's more differentiation there. So this is going to be a more growth-oriented portfolio, and then those return values divided by these risk values gives us these utility functions, which then combine to create a portfolio strategy. We'll just click the Optimize button and produce that portfolio. So this policy tree, you can see how it's kind of like the DNA of a portfolio. It's the instruction set that allows any portfolio to get built and optimized. And thanks for spending a little time with me to learn about our policy tree. And stay on the lookout for some other videos on our YouTube channel. Thank you.